Position in Forex for beginners. Imagine learning about lot sizes, pips, and currency pairs, then opening your first trade without understanding what you've actually done. It happens to thousands of beginners every day. They know how to click the buy or sell button, but they don't understand one of the most important concepts in Forex, a position. The truth is, every trade you will ever place begins with opening a position. If you don't understand what a position is, you'll struggle to understand many other Forex concepts as you continue learning. The good news is that it's actually one of the simplest concepts in trading. So in this video, I'll explain what a position is, the different types of positions, and why understanding this concept is essential before you place your first trade. Let's get started. What is a position in Forex? A position in Forex is simply an active trade that you have opened in the market. The moment you buy or sell a currency pair, you have opened a position. That position remains active until you close the trade. It doesn't matter whether the trade is making a profit, making a loss, or sitting at break-even. As long as the trade is still open, you have a position in the market. This is why traders often say things like, "I opened a position," "I'm holding a position," or "I just closed my position." They're simply referring to the status of their trade. Why is it called a position? The word position describes your place in the market after you've entered a trade. Whenever you buy or sell a currency pair, you're taking a position based on your analysis. You believe the market is likely to move in a certain direction, so you enter the trade accordingly. As long as that trade remains open, you have a position. Once you close the trade, your position ends. It's really that simple. Position versus position trading. Before we move on, let's clear up a misunderstanding that confuses many beginners. A position is not the same as position trading. A position simply means an active trade. Every trader has positions, regardless of how long they keep their trades open. Position trading, however, is a trading style. Position traders hold their trades for weeks, months, or even years because they're trying to capture large, long-term market movements. In this video, we're only talking about what a position is. We'll cover position trading, along with other trading styles like scalping, day trading, and swing trading in future lessons. Types of positions. In Forex, there are only two types of positions, a long position and a short position. Let's look at each one. Long position. A long position, also called a buy position, means you expect the price of a currency pair to rise. Because you believe the price will go up, you buy first. For example, let's say euro to US dollar is trading at 1.1000. After analyzing the market, you believe the euro will strengthen against the US dollar, so you open a buy trade. If the price later rises to 1.1100 and you decide to close your trade, you've made a profit because the market moved in the direction you expected. Whenever you hear the term long position, simply remember that it means buying because you expect the price to increase. Short position. A short position, also called a sell position, means you expect the price of a currency pair to fall. Instead of buying first, you sell first. Suppose GBP/USD is trading at 1.3000, and after your analysis, you believe the price is likely to fall. You open a sell trade. If the market later drops to 1.2900, you close your trade and make a profit because the price moved downward. This is one of the unique advantages of Forex trading. Unlike some other markets, you have the opportunity to profit whether prices rise or fall. Open position versus closed position. You'll also hear traders talk about open positions and closed positions. An open position is simply a trade that is still active. Since the trade is still running, your profit or loss continues to change as the market moves. A closed position is a trade that has been exited. Once you close the trade, the result becomes final. Your profit or loss is locked in, and you no longer have a position in that currency pair. Understanding this difference is important because many beginners use these terms interchangeably, even though they mean different things.
What makes up a Forex position? Every position is made up of several important components, and each one plays a specific role in your trade. The first is the currency pair. This is the market you're trading, such as EUR/USD or GBP/USD. Every position begins with choosing the currency pair you want to trade. The second is the trade direction. You decide whether you're opening a buy position because you expect the price to rise or a sell position because you expect the price to fall. Next is the lot size. This determines how large your position will be. A larger lot size means your potential profits can be bigger, but it also means your potential losses can be larger. That's why choosing the right lot size is an important part of risk management. Another component is the entry price. This is the exact price at which your trade is opened. It serves as the starting point for calculating whether your position is in profit or loss. A well-planned position should also include a stop loss. A stop loss automatically closes your trade if the market moves against you by a certain amount. Its purpose is to limit your losses and protect your trading capital. Finally, there's the take profit. This is a price level where your trade automatically closes once your profit target has been reached. It helps traders lock in profits without having to watch the market all the time. When all of these components come together, they form a complete Forex position. Common beginner mistakes. Now that you understand what a position is, let's look at some of the most common mistakes beginners make when opening one. The first mistake is believing that opening more positions automatically means making more money. It might sound logical, but it isn't true. Every position you open carries risk, so the more positions you take without a clear strategy, the more money you expose to the market. Successful traders don't measure success by how many positions they open. Instead, they focus on opening the right positions at the right time. The second mistake is opening a position without first analyzing the market. Many beginners see the price moving quickly and jump into a trade because they're afraid of missing an opportunity. This often leads to emotional decisions rather than well-planned ones. Experienced traders don't open positions simply because the market is moving. They wait patiently until their analysis and trading plan give them a valid reason to enter. The third mistake is failing to manage an open position. Some beginners believe that once they've entered a trade, all they have to do is wait and hope for the best. In reality, opening a position is only the beginning. A well-managed position requires discipline. It means sticking to your trading plan, resisting the temptation to move your stop loss out of fear, avoiding emotional decisions, and knowing when it's time to close the trade. Even a good trade idea can end badly if the position isn't managed properly. These mistakes happen more often than you might think. Before opening any position, always ask yourself one question: why am I entering this trade? If you don't have a clear answer, it's usually better not to trade. The goal isn't to open more positions. The goal is to open well-planned positions that fit your strategy and manage them with discipline. Let's quickly recap what we've learned today. Today, we've learned that a position is simply an active trade in the Forex market. The moment you buy or sell a currency pair, you open a position, and that position remains active until you decide to close it. We've also learned that there are only two types of positions: a long position, also known as a buy position, and a short position, also known as a sell position. We discussed the difference between an open position and a closed position, explored the key components that make up every Forex position, and looked at some of the common mistakes beginners should avoid when opening and managing their trades. Understanding what a position is one of the most important building blocks in Forex trading because every trade you'll ever place begins with opening one. The stronger your understanding of this concept, the easier it will be to understand many other topics as you continue your Forex journey. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more beginner-friendly Forex lessons. Thanks for watching. Keep learning, keep practicing, and I'll see you in the next lesson.